everybody. I'm Vern Cushenberry, Chief Investment Officer, and I'm back with another quarterly update. And I'll give you the bottom line up front. There was nothing this quarter that looked out of bounds from what we typically see. A little bit of volatility, and I'm going to talk about some of the headlines that drove that volatility, give you a market update in general, field a few questions that we got from our audience this quarter on oil, alternative investments, the almost government shutdown, and interest rates. Getting more questions on interest rates, and that probably is the biggest topic. But I like to start these updates by giving you the bottom line up front, and that is, if you're a typical investor saving for retirement, your portfolio is probably allocated towards something that looks like a target date fund that will de-risk that investment account as you approach retirement. And there's absolutely nothing that I'm going to say this quarter that would cause you to deviate from that plan. So with that, let's jump into it. You can see what the markets did this quarter. A little bit of red. We had been on a nice upward slope for the last year and a half, and we gave a little bit of that back this quarter. That's not atypical at all. You saw U.S. markets down about 3%, global markets down about 4%, and the U.S. bond market down about 3% too. But if we take this next slide here and pan out a bit, you can see all green across the 1 year, 5 year, 10-year time spans. This is what the market does and what we expect the rewards that accrue to the patient investor over time. These are something similar have always been available to the patient investor, and that's the primary task at hand in saving for most of the goals that our clients are looking out for, whether that be retirement planning or legacy management or some sort of charitable giving. Nice to see the green there in the longer run, and that's really my job, is to reframe everybody's focus on what we're after, to take the 30,000-foot perspective and work that into the financial plan on a case-by-case basis so that we can customize that a little bit for your specific landing point per se. Here's a look at the past 3 months and some of the headlines that have driven a little bit of that volatility. Most of this is just noise. It's my job to take the noise out of the daily headlines. When you sit down at night to watch the news or CNBC, you have to remember that those media outlets, they get paid to provide 24/7 content, and that requires a little bit of sensationalizing. So let's remove that a little bit. And the biggest headline that you see here on this chart is probably Fitch. We had Fitch lower the U.S. credit rating this quarter from AAA to AA+, and that was in the lead up to the potential government shutdown. Now, Congress bought us another 6 weeks, but it's going to be coming back around. So I wanted to speak to that a little bit, and I have a slide devoted to that. But you also saw that another headline here is U.S. mortgage rates hit 7%. That will have an effect on the housing market. It has already had an effect on the housing market. New home sales are declining precipitously. A 7% interest rate has a big effect on that monthly payment, as many of you probably already know if you've looked for a new house. So that will have a slowing effect on the economy, but it's not unusual by any stretch if you look back at the history of interest rates and mortgages. So we're not sounding any alarm bells, we're just pointing that out. Okay, government shutdowns. I went out and I found this chart after a couple of our investors asked us whether they should be worried about the potential government shutdown. And if you look back at the history of the markets and the way they have reacted, maybe 30 days prior and 90 days after a potential government shutdown, well, here's the last 6. I took a look at the last 6 shutdowns. This chart's actually from Yahoo Finance. But you can see beginning day zero, the horizontal axis looks subsequent to the government shutdown. After you get about 2 weeks after a potential government shutdown, there's no impact as measured by stock market returns, which gives us a little bit of relief that these are normal operating practice when it comes to government budgetary needs. So it helps us contextualize what we're dealing with. Let's shift gears a little bit and look at the markets. We're still on a nice little upward trend. If you go back and look at October 12, 2022, the S&P 500 was at 4.3577, and as of the end of the quarter, it was at 4,288. That's a nice 20% upward move. We always look at valuations. Let's contextualize that a little bit and look at the history of the stock market as it is measured in a very simplistic price to earnings ratio. Right there in a reasonable range. So nothing to worry about there in terms of being particularly expensive or particularly cheap. Oil markets. I got a question about oil markets this quarter. Oil has risen significantly since COVID, for sure, which has been a large contributor to the overall spike in inflation. And we've seen that jump up in the past quarter too, which caught the attention of some of our investors. Now trading at $90 per barrel as of the end of the quarter. A couple things just to point out here when it comes to oil and how we might think about the price of oil going forward for the next few weeks, months, quarters. You can look at production here on the left-hand side of this chart. You see production coming out of the US. And I want to point out that if we just pan across 19, 20, 21, and 22, you can see that production's gone from, in round numbers, 19 million barrels a day to 18 to 19, and then it jumped to 20 million barrels a day in 22. And then in 23, we're producing on trend 21.6 million barrels of oil per day. So the US continues to be the marginal source of production for increased production on a global basis. If you compare that to OPEC, OPEC has actually decreased production by about 1 million barrels per day, and Russia's about flat, leading global production. If we're going to increase it, it has been dependent upon the US to do that. So how does the future look for that increased production in the United States? Well, we look to rig counts. Now pan down to the bottom left side of the screen, and you can see rig counts in blue have fluctuated between 1,200 and call it 800-900 on the low end. We're on the low end of that now. If we're gonna continue to pump more oil, we need to see rig counts increase. The last time oil was at these levels, rig counts were approximately 30% higher than they are today. So that's information that informs how we view the oil market, and I hope it's helpful for a few of the investors that had asked questions about oil this quarter. Okay, let me move on to interest rates. Interest rates caused a few questions, comments for some investors, and those comments come when you open your statement at the end of the month. And I'm going to review this because when interest rates rise, bond prices fall. So if you have bonds in your portfolio, and everybody does, everybody has bonds in their portfolio, it's an appropriate diversification strategy. We should have bonds in our portfolio. But when interest rates rise, the prices of those bonds fall. And I want to walk through the dynamics of how that works and hopefully impart an aha moment for a few of our investors who haven't revisited this conversation in a few months, a few quarters, a few years, maybe never. And add some wisdom to the financial plan. So before I move on there, I want to point out, if you look at the 10-year in blue, this is the 10-year US Treasury yield. So these are bonds that are issued by the federal government. They're guaranteed. They're as good as the federal government's credit rating. So if the US government can't pay you back, then the world is in a heap of trouble. So let's consider that to be the risk-free rate. If you're taking a finance class, that's what we call the risk-free rate. Those are guaranteed bonds. So you're guaranteed to get paid back. And you can see what happened to the interest rate here just in the last year and a half. It went from a low of, well, let's just call it 2% up to 4.5% now on the 10-year Treasury. So interest rates are increasing. What happens to bond prices? Rates rise, bond prices fall. When interest rates fall, bond prices rise. So let's take a look at this spreadsheet here and see if it's helpful at all for making my point. So in this spreadsheet, I'm looking at a $10,000 US Treasury bond. So from day one, call it time zero or the year 2023, assume that you as the investor spend $10,000 to buy a bond from the US Treasury that's going to pay you 5% interest. So I modeled that out here. You can see the bond purchase in yellow. It's $10,000. That's in red because that's a cash outlay. The interest rate is 5%. So you can see the interest payment is going to be $500. And I've simplified the compounding here, but $500 in 2024, an additional $500 in 2025, and so on and so forth until 2023, when that bond comes to term. And you can see the return of principal payment there on line 11 also is paid in 2023. Then on line 12, we can see the total cash flows in each of the years. In 2023, we have a cash outlay of $10,000. We receive interest payments of $500 in each of those 10 years. And finally, in 2033, we receive an interest payment of $500 and the return of our principal, which is guaranteed because we're dealing with the US Treasury, of $10,500. Now, if you analyze all those cash flows, what you're going to see is that you calculate an interest rate of 5%. Now, the question is, what happens when interest rates go from 5% to 6% or from 5% to 7%? Well, the spreadsheet tells us. I can type in 6% here, and you can see what changes is the yellow highlighted cell. That bond, which we had paid $10,000 for, is now only worth $9,264. The price of that bond has declined. So the number that you see on your statement at the end of the quarter is also going to decline. It shows what effectively looks like a loss. But here's what's important to focus on. The cash flows associated with that bond are all in green here. Absolutely nothing changes about the $500 you're going to receive in years 2024 through 2033. Nor does anything change about the return of principal that you're going to receive in year 2023, because that's guaranteed by the US government of $10,000. So everything highlighted here in green is 100% guaranteed. The loss, quote unquote loss, showed up because interest rates rose in the period, and now the current value of that bond, if you were to go sell it, would be less. Okay. Now, how are we supposed to think about that if we're saving for retirement? Well, if you're saving for retirement, you're primarily concerned about the numbers here in green. So any change in the numbers in yellow should be less of a concern. So let me contextualize this a little further. I pulled in this slide. I teach at the University of Missouri here in Kansas City. I teach financial statement analysis. And this is a slide from Module 7, so week 7, that I share with all of the master's level students in my financial statement analysis class. And this slide talks a little bit about how corporate America records the changes in the values of those bonds. So the example here that the authors are giving is Verizon Communications. Verizon Communications owns some bonds on their balance sheets. And the rules associated, the accounting rules associated with how those reported, actually allow changes in fair value to be excluded, or in red, the text in red says they are not included in net income. So the accounting rules allow for corporate America not to disclose those losses if they intend to hold those treasury securities to maturity. So the math that we just looked at, they're recognizing here that the principal value, or the amount that they expect to get repaid, hasn't changed. And therefore, they're not recording that as a loss. Contrast to that to what retail investors experience on a month-by-month basis when they get their statements in the mail. You absolutely see that loss. Which is more appropriate? If those cash flows are what determine the success and or failure of your retirement, and the repayment of that principal is what determines the success and or failure of your retirement, is it more important to show, more appropriate to show the loss? Or is it more appropriate to think of that as a guaranteed future repayment of your principal, which is exactly what you intended when you bought the original bond? Well, corporate America gets the benefit of thinking about that in latter terms. It's all very complex and wonky, and this is a master's level finance class that I teach, but I thought it worthy of sharing with my audience this quarter, because we do continue to see volatility in the bond market and volatility in interest rates. And I don't want any of our investors making knee-jerk decisions in reaction to some of that volatility in their bond market when it doesn't have an effect on the outcomes that we're going after as we engineer those portfolios. Okay, lastly, I got a couple questions this quarter, and thank you again for all the questions. It really helps me design these quarterly presentations in a way that adds some value back to our investor bases. So I get a couple questions on alternatives, and I want to couch this in risk terms. Alternatives are risky. They are illiquid. They don't trade on the Nasdaq or the NYSE. They don't trade like bonds. Typically, they're private market securities. So private equity, hedge funds, venture capital, infrastructure, private real estate deals. You can't get a quote for these investments oftentimes. So because they are risky and risk comes with reward, they have been shown in some studies to lessen the overall rate of risk in your portfolio and increase the return. And that's partially evidenced by the degree to which these holdings are held by endowments and insurance companies, other sovereign wealth funds, so on and so forth. On a very selective basis, we have some of these available for our investors that are above a certain net worth threshold, and the SEC dictates that threshold needs to be $2 million and up, and these are appropriately held in non-retirement portfolios, so taxable portfolios. So for the select investor, a small number of alternatives, can work in your favor. They are absolutely more risky, and they really need to be considered on a one-by-one type of basis. And the last chart I'll share with you this quarter is this one, showing in green here. You can see the number of asset classes that your typical endowment portfolio has. So your typical endowment portfolio is split up between equities, fixed income, hedge funds. They have 18% exposure to hedge funds, private equity, 12%, private real estate, 5%, other alternatives, 15%. So you can see a healthy percentage allocated to private investments. But keep in mind here, endowments have an unlimited lived portfolio. And what does that mean? Well, we think in terms of time horizon when we're setting asset allocation. So the time horizon for most endowments is infinite. Those portfolios are set up to power their goals off of the cash flows from that investing portfolio, and the corpus of that, or the main portion of that, is meant to last forever. So some allocation to illiquid investments can be considered appropriate in that type of environment. So if you're interested in that and you meet those criteria, reach out to your financial planner, reach out to me or another member of my team, and we can have that conversation and advise you on whether that might not be appropriate for your specific goals. And with that, I'll say thank you once again. I'll be back with another quarterly update in 3 months.